Welcome to the step-by-step guide for a rookie real estate investor looking to buy a property. This comprehensive guide will walk you through the essential steps, pros, cons, and tools you'll need to succeed. Step 1. Define your investment goals. Before starting, determine your objectives: cash flow, appreciation, flipping, or portfolio diversification. Step 2. Choose the property type. Here's a breakdown by property type with pros, cons, and tools for each. Single-family homes, or SFH, are ideal for beginners seeking lower risk. Pros: high demand for rentals, easier to finance with traditional loans, simpler to manage and maintain, and easier to sell. Cons: limited cash flow compared to multifamily properties, vacancy risks, and market appreciation dependent. Tools needed: MLS, Zillow or Redfin, DealCheck or BiggerPockets Calculator, and Stessa. For example, you could buy a single-family home in Newark, New Jersey for $300,000, rent it out for $2,500 per month, and achieve $800 per month in net cash flow after expenses. Multifamily properties such as duplexes, triplexes, and quadplexes are ideal for investors wanting more cash flow and scale. The pros include multiple income streams, which reduce vacancy risk, qualification for residential financing, and they are great for house hacking. However, there are cons too: higher initial cost and down payment, more management-intensive tenant turnover, and maintenance can increase expenses. The tools you will need include CoStar or LoopNet, a rental property calculator, Tenant Cloud or Buildium, and DocuSign. For example, you could purchase a triplex in Trenton, New Jersey for $450,000 with $3,500 per month in rental income. After mortgage and expenses, you could net $1,200 per month. Fix and flip properties are ideal for investors comfortable with renovation projects. The pros include potential for high short-term profits, adding value through upgrades, and the opportunity to buy undervalued properties. On the flip side, the cons are high risk if market conditions change, the need for upfront capital for renovations, and unexpected repair costs that can eat into profits. Tools needed for this strategy include PropStream, Buildertrend or Home Depot Calculator, hard money lender platforms, and DocuSign. For instance, you could buy a distressed home in Camden, New Jersey for $150,000, spend $50,000 on renovations, and sell it for $250,000, netting a $50,000 profit. Commercial properties, including office, retail, and mixed use, are ideal for experienced investors with access to capital. The pros are higher income potential and longer lease terms, tenants often cover property maintenance, and a diverse tenant base reduces risks. But there are cons: it requires significant capital and expertise, economic downturns can reduce demand, and there are complex lease agreements and zoning laws to navigate. The tools you need include LoopNet or CoStar, financial model templates, commercial lender contacts, and legal counsel. For example, you could buy a mixed-use building in Hoboken, New Jersey, with retail on the ground floor and apartments above, generating $8,000 per month in rental income. Vacant land, ideal for long-term investors or developers. Pros: low purchase price and carrying costs, opportunity for custom development, can appreciate as surrounding areas develop. Cons: no immediate income, requires knowledge of zoning and permits, development costs can be high. Tools needed: LandGlide, County GIS Maps, Buildertrend or Estimator, 360, legal counsel. Example: purchase land in Princeton, New Jersey for $100,000, rezone it for multifamily use, and sell to a developer for $250,000. Step 3. Secure financing. Explore financing options: conventional or FHA loans, hard money loans, private money, or partnerships. Step 4. Conduct due diligence. Inspect the property, analyze the market, run the numbers. Step 5. Build a team. Assemble your team of real estate agent or realtor, mortgage lender, real estate attorney, property manager, and contractors. Step 6. Make an offer. Negotiate based on your analysis, use contingencies like inspection and financing to protect yourself, and be prepared to walk away if the numbers don't work. Step 7. Close the deal. Secure financing, ensure all inspections and appraisals are completed, and review the closing disclosure to avoid hidden costs. Final thoughts. Each property type has unique opportunities and risks. By following these steps and using the right tools, you'll make informed decisions and set yourself up for success. Would you like help with specific strategies, such as finding off-market properties or working with lenders?